Alphabet stock has pulled back recently. The concern isn't weaker revenue or profitability, it's AI. Many investors worry that AI could disrupt the business model that made Google so successful. But after looking closer, I think the market may be overlooking something. Google's biggest advantage may be far harder to replace than many people realize.
Hey everyone, I'm Austin. Welcome back to the Everyday Investor. Lately, there's been a lot of debate around Alphabet. Some investors believe AI is becoming a serious threat to Google's core search business. Others think the market may be overreacting. So today, I want to take a closer look at what's actually happening. Is Alphabet facing a real long-term problem, or is this just another case of the market getting ahead of itself?
To understand why investors are worried about Alphabet, we first need to understand how Google actually makes money. For more than 20 years, Google Search has been one of the Internet's main entry points. Whether you're looking for information, shopping online, booking a flight, or trying to find a restaurant nearby, chances are Google is still the first place you go. And that user behavior helped Google build one of the most successful advertising businesses ever created. The concern is that AI could change that. If more people start asking AI directly instead of using traditional search, does Google lose its most valuable advantage? That's really what investors are worried about. But there's an important difference between what people fear and what's actually happening. Today, Google still controls close to 90% of the global search market, and search advertising remains Alphabet's largest source of revenue. In other words, the market is pricing in a future risk. But so far, Google's most profitable business hasn't shown the kind of weakness many investors seem to expect. And I think that's the part investors should be paying attention to. It's one thing to worry about what could happen in the future. It's another thing to look at what's actually happening today. Because right now, Google Search still holds an incredibly strong position. For long-term investors, the question isn't whether Google has competitors. The question is whether those competitors are actually affecting Google's ability to make money. Google Search is still an incredible cash flow machine. A lot of people think of search as simply a way to find information. But from a business perspective, the real value of search isn't the information itself. It's the intent behind the search. When someone searches for flights, insurance, mortgages, or a product they're thinking about buying, they're often very close to making a decision. And Google's biggest strength has always been its ability to place relevant ads in front of users at exactly the right moment. That's why Google has never really been selling traffic. What it's selling is commercial intent. And that's one of the reasons search advertising continues to generate such enormous revenue and cash flow. So when investors focus on what Google could lose someday, it's also important to recognize what Google already has today. Because truly powerful business models don't usually disappear overnight just because a new technology comes along. And that's why I don't think Google's value can be measured by traffic alone. Traffic by itself doesn't automatically generate profits. What matters is whether a company can consistently turn user demand into revenue and cash flow. That's exactly what Google has done for decades. But if that advantage is really this strong, then the next question becomes, is AI weakening that advantage or making it even stronger? Many investors assume that AI and search are direct competitors, as if using AI automatically means people stop using Google. But reality may be a lot more complicated than that. Historically, new technologies don't eliminate demand. They usually change how that demand gets fulfilled. In the past, users had to browse through multiple websites and piece together information from different sources. The goal of AI-powered search is to help users find answers faster and more efficiently. From that perspective, AI may be improving the search experience rather than replacing search itself. And that's one reason Google continues integrating AI into its search products. At the same time, Gemini is becoming more deeply integrated across Google's ecosystem. If AI helps Google better understand what users are actually looking for, advertising could become even more targeted and effective. And if that happens, AI may not reduce the value of search at all. It could actually increase the commercial value behind every search. In my view, many investors assume AI will eventually replace search. But if Google successfully integrates AI into the search experience, AI could become a tool that strengthens search instead. And those two outcomes would have very different implications for Alphabet's future. That said, even if we set search aside for a moment, Alphabet's growth story isn't dependent on search alone. One of Alphabet's most important growth drivers today is Google Cloud. For years, most investors viewed Alphabet primarily as an advertising company, and that's understandable. Advertising still generates the majority of the company's revenue and profits. But as demand for AI infrastructure continues to grow, Google Cloud is becoming increasingly important. Because deploying AI at scale requires a lot more than just powerful models. Companies also need computing power, storage, and cloud infrastructure. And Google Cloud sits right in the middle of that trend. Over the past few years, Google Cloud has continued growing while steadily improving profitability. That means cloud isn't just contributing to revenue growth anymore. It's starting to contribute meaningful profit growth as well. And for Alphabet, that's important because it means the company's future growth is becoming more diversified. But Alphabet's growth story isn't just about search anymore. As Google Cloud continues to grow, the company is gradually building a second growth engine. And when a business starts generating growth from multiple sources, investors tend to look beyond today's earnings. The bigger question becomes how much value those growth drivers can create in the future. And that leads to another important question. Has the market fully priced that in? Looking at Alphabet's current valuation, the answer may not be as obvious as many investors think. Compared to some of the market's favorite AI companies, Alphabet still trades at a relatively reasonable valuation. And that suggests many investors are still valuing the company primarily as a traditional advertising business. But Alphabet today is much more than that. It owns one of the most profitable search businesses in the world. It has a fast-growing cloud platform, and it's actively integrating AI into its core products. If AI ends up strengthening the value of search, if cloud continues gaining market share, and if advertising remains a powerful, cash-generating business, then Alphabet's future upside may come from more than just revenue growth. It could also come from a re-rating of the business itself. From that perspective, the market seems focused on the risks today. But long-term investors may see an opportunity that isn't fully reflected in the stock yet. So in my view, the key question isn't whether investors are worried about AI. It's whether that concern is already priced into the stock. If search, AI, and cloud continue to grow together, Alphabet may have more upside than the market expects. That's why I believe its long-term value may still be underestimated. What do you think? Let me know in the comments. I'm Austin. Thanks for watching, and I'll see you next time.